Hey everyone, and welcome. Today, we're going to do something really cool. We're going to take all the complicated stuff about stock analysis and just toss it aside. Instead, we'll use a super simple but incredibly powerful checklist inspired by, you guessed it, Warren Buffett himself. And we're not just talking theory here, we're going to put a real, live company under the microscope.
So here's the big question, right? It's the one every single investor faces. How do you tell the difference between a company that's just good and one that's truly great? One that's actually built to last. And maybe even more important, is it a smart buy right now? To figure that out, you really need a solid framework, a kind of checklist to help you see clearly.
So let's get right into it. This is the Buffett checklist. Now, we're using a simplified take on his legendary philosophy, and we've boiled it all down to just 3 simple tests. But don't let that fool you. It's powerful. Why? Because it completely changes your mindset. It forces you to think like you're buying the whole business, not just, a little blip on a stock screen. Okay, here they are, the big 3. Number 1, does the company have what Buffett calls a moat? Some kind of durable competitive advantage that keeps the competition at bay. Number 2, is it consistently profitable? Like a real money-making machine over the long haul. And finally, number 3, can we buy it at a fair price? A price that gives us what he calls a margin of safety. And the company we're going to put through this ringer is one you probably have in your kitchen right now. McCormick & Company, the spice and seasoning giant.
All right, let's dive into test number 1. Does it have a moat? I love this idea. Think of a castle, right? The moat is what protects it from invaders. For a business, that could be anything from a brand name everyone trusts, some kind of special technology, or just being so big that nobody can compete on price. So, the big question is, does McCormick have one? Let's start digging.
Okay, check this out. This one number, it says so much. 38. 38 consecutive years of increasing their dividend. Just stop and think about that for a second. That means through every recession, every market crash, every crazy thing the world has thrown at us for almost 4 decades, this company has made enough money to not just keep the lights on, but to actually give more cash back to its owners year after year after year. If that's not a sign of an incredibly stable business with a wide moat, I don't know what is.
And here's another piece of the puzzle. This shows us just how good the company is at making money with the money it already has. Take a look at that return on equity, the ROE. It's over 23%. Now, to give you some context, Warren Buffett often looks for companies that are consistently over 15%. So 23%, that is absolutely exceptional. It's proof that the people running the show are just fantastic at turning every dollar of shareholder money into even more profits.
So it's pretty clear McCormick has a strong moat. That's a huge checkmark for test number 1. But, a great defense isn't enough. A truly great business also has to have a great offense. We need to see that moat translating into actual, consistent profitability and growth. So let's jump into test number 2 and check out the company's track record.
Okay, now this is where things get really interesting. If you look at the top line, revenue, the growth is, it's steady, it's solid, but then look at the bottom line. Whoa. Check out the growth in net income and especially the earnings per share or EPS. That's not just growth, that's almost explosive. And that's a massive signal right there. It tells us the company isn't just selling more spices, it's getting way more efficient and profitable at it. They're making more money on every single sale.
All right, let's recap. We've got a check for the moat and a big check for profitability. So, McCormick has passed our first 2 tests with flying colors. But here's the thing, and this is so important. Even the most amazing company on earth can be a terrible investment if you pay too much for it. And that brings us to the final make or break test, the price. Is it a fair deal today?
This chart right here gives us a massive clue. It's looking at the price to earnings ratio, or PE. It's basically a quick way to see how expensive a stock is. Now look at this. Right now, McCormick's PE ratio is sitting around 8.5. But then look at where it's been on average for the last 3 years, way up at over 24. You don't need to be a math whiz to see that. The stock looks way cheaper right now compared to its own recent history. And if we put that into actual dollars and cents, it gets even clearer. The stock is trading for about $52 a share. But when you run some calculations based on how much cash the business is expected to make, its fair value might be closer to $61 or $62. And that gap, that difference between what you pay and what it's actually worth, well, that's the holy grail for a value investor. And there it is, the payoff.
That gap gives us what Buffett famously calls the margin of safety. In this case, it's almost 16%. This is maybe the most important concept of all. It's your safety net. It's your cushion. It's the room for error that protects you if, hey, maybe your calculations were a little off, or if the company hits an unexpected snack. Having a solid margin of safety is what separates just buying a good company from making a truly great investment.
Okay, so let's bring it all together. We've put McCormick through the ringer using our three-part Buffett checklist, and it looks like it passed the moat test, the profitability test, and the price test. So, what's the final verdict? What does all this evidence actually tell us?
So here's the whole case, laid out plain and simple. On the one hand, the points in its favor are really strong. You've got that incredible 38-year history, fantastic profitability, and what definitely looks like a bargain price right now. But you gotta look at the other side too. The stock's performance lately has been, well, pretty bad, and that revenue growth has slowed down. So at the end of the day, the big question you have to ask yourself is this: are these just short-term headwinds, a temporary blip, or are they a sign of a deeper, more permanent problem?
And that really gets to the heart of what this is all about. This was never just about McCormick. It's about giving you a framework, a new way of thinking. It's a simple, repeatable process you can use on any company. When you learn to focus on these three things, a durable moat, consistent profits, and a fair price with a margin of safety, you start to build real confidence. You can start making your own smart decisions. So the only question left is, what company are you going to put to the test next?